Well, the US equity juggernaut continues to roll on with the S&P firmly above 6,200. We look ahead to US earnings on the 15th of July with JP Morgan kicking things off, and we expect another pretty good earnings season to come through. Now, we look ahead at the risks. We've got the non-farm payrolls numbers. We've got trade deal deadlines. We've also got the big, beautiful bill, which is still yet to be passed, and a lot of contentious points around that. But certainly the equity market on a bit of a flyer, and we've got this nirvana kind of backdrop playing through. The same can't be said for the US dollars, which is certainly down and out at the moment. But, well, we're looking at the risk reward around what happens around next. Do we chase the market down at these levels, or we do look for mean reversion? Of course, non-farm payrolls could be the big catalyst around that. We've closed out the dollar for the first half of the year at the weakest levels, or the worst performance, should I say, since 1973, just the year after Blake was born. We look at crypto, we look at gold. There's a lot going on in these financial markets. This is the trade-off. Well, hi, I'm Chris Weston, Head of Research here at Pepperstone, and we're joined in 2 seconds by Blake Morrow, the one big, beautiful Blake from Forex Analytics. And we'll be discussing all the factors that are going on in the world of markets, the trades we like, the directional views, how we manage risk, some of the event risks which potentially could be coming onto our radar and could kick up a cheeky bit of volatility. Mr. Big, one big Blake Morrow coming to the programme, my good sir. How the devil are you?
Well, I'm great. Thank you for the wonderful introduction, Chris. And by the way, I'm sorry, I was only 1 year old. What happened when I was 1 year old in 1973?
Well, in 1973, I think America pulled out of Vietnam. That was one. What else happened in that? Arsenal came second to Liverpool in the what was the English Champions League at the time. I can go on with many sort of dates for the diary. But Watergate, I think, was in 1973. I'm
never going to play a board game with you again that has to do with facts and figures. Never, ever.
There you go. And I think that was also the year that Australia lowered the legal voting age to 18 as well. There you go. Yeah. Wow. So there we go. Facts and figures for y'all. Anyway, Blake, how are you, mate? You well, going well? Enjoying these financial markets?
I'm doing great. You know, it's we're about ready to celebrate our independence from, you know, the horrible British folk, on Friday. So, oh, that's you. I'm sorry, Chris. Is that you? Or are you
I just talked about France, isn't it? The French may have helped or something. I'm not sure. I can't remember. Anyway, we are united as one, mate. Part of the world allegiance. So there we go.
The world allegiance. No, I'm doing great. You know, it's an interesting trading week because everything's crammed into a few days here in the U.S. Tomorrow's obviously going to be a big day with the jobs report. And then we're going to, here in the United States anyway, I know it's very limited viewership that comes in from the United States for the show, but we are going to be celebrating our independence. And so it's a good week. And it's been actually decent volatility. I love the price action that we've seen over the last couple of days. We're going to be talking about that through this entire
Well, mate,
episode.
I hope the Morrow family have a wonderful Independence Day celebration. I'm sure you have. I can imagine you're all getting together, a big feast in your white Oval Office, and I hope you have a really, really great day, mate. So enjoy that. Anyway, let's go to Topical Thunder. Right, S&P flying high. Let's talk equity. We've got this. It has been a Goldilocks scenario for a long time now, really. But to be honest, we've got this situation where the data's okay. It's slowing, but it's not cracking like that. Obviously, payroll is very much front and centre. We did see the ADP numbers coming out at the worst level since 2023, but we can sort of ignore that a little bit. It's been a bit, a great predictor, of course, for payrolls, which is, of course, what the market puts a lot more weight on. The bears will find stuff in the data flow to suggest things aren't great. But we've got an economy which is slowing. People are seeing some signs that goods inflation may rise in the coming months, but not get too carried away. But yet the Fed are expected to cut 100 basis points to get the Fed funds rate down to its trough. That's a great situation. Earnings have been revised up in S&P earnings by about 1.1% over the last 4 weeks. Earnings resilience is there. And of course, you've got a situation where the US dollar's been falling. And I think that's a majorly underappreciated tail risk for the equity market. So many of these mega cap companies are earning revenues overseas and obviously report that in dollars, and so that's obviously a big situation. So I think when you've got the people who tried to short the market, they got blown out. yeah, there's money coming in. Volatility is still very low. Both realised volatility in the S&P is about 10% year-to-date lows, and that's pulling down the VIX, pulling down implied vol, and that's bringing more capital from the vol dynamic fund. So can anything shake this market, or do we just continue to rotate and push this index higher?
Well, you failed to mention one other thing that's really it's a little tailwind that the market has is, the potential of a shadow Fed. And I know, we discussed
Can we talk about that in the dollar?
Well, yeah.
No, bring it up. Okay. Come on, let's hit me. Let's go.
But just a few short minutes ago, the true shadow Fed actually made some comments on Truth Social, and he said, "Too late, should resign immediately." That would be from,
the true shadow Trump. Fed. Trump is the shadow Fed, yeah.
And he says the Fed chair should be investigated by Congress. FHFA head says, and
that was William Poulter, wasn't he? The head of the about some renovations that are taking place or something.
I mean, between that and what's happening with Sean Diddy Combs, I don't know what's happening in this country. I don't know. But anyway,
get out.
I should. I'm going to come join the Great Alliance with you. I'll be right over. No, but jokes aside, though, I mean, you have this shadow Fed. We'll talk about that. You got Trump that's actually more of the shadow Fed than anything. And then on top of that, you got a jobs report tomorrow. And now the interesting thing, and we're going to talk a little bit about this here in just a few short minutes about non-farm payroll, but I think the jobs report is the one thing that could actually have a bit of a negative impact on equities. And because we saw like the knee-jerk reaction this morning, the jobs report is going to be critical. But then I want to actually talk a little bit more about the jobs and the importance of it here in a few seconds. But is anything going to derail the S&P, Chris? This is a Teflon market. You can throw anything against it and it doesn't stick. So
yeah, that's right. And I think I love the rotation. Energy was working well last night. Financials have been blowing up. The fact that you've got the XLF at all-time highs, that's not indicative of late cycle economics. You do not see banks at all-time highs when people say the economy is going into recession. So obviously, I know there's issues. They've been paying dividends, high dividends. The SLR has been helpful. But we like that. JP Morgan kicked things off. That stock looks really good at the moment. Pullbacks are a buying opportunity, in my opinion. But also, you've gained so much love for NVIDIA and the AI plays, semis. They've had maybe a bit of a peak. Maybe it was due for some consolidation. But the semi trade, as we go into, so much of the negatives that have happened have just given us this checklist to say, right, let's bid it up. I mean, we've got all the hyperscaler businesses have committed to capital. Microsoft was a big concern there. Their Azure department, in the last earnings report was very strong, and that sort of committed to capital. NVIDIA have their margins expanding for the end of the year. We're expecting their margins to pick up. And they've got these sovereign deals coming through as well. So we like that space as well. But now you've got Apple coming to the party. We'll talk about that in a second. So you've got this great rotation. You've got a real strong bid coming back into AI plays. Broadcom, Marvell, all these names, not just NVIDIA, Supermicro. I still feel in this backdrop, pullbacks are buying opportunity. I just stay long until you're proven wrong, I guess.
Yeah, and I guess one last thing we should probably discuss, Chris, is that remember, following Liberation Day, and this is something I talked about on my video, my weekly video. I'm like, look, there are so many people chasing the market at this point. How many you listen, and I'm sure you listen to a lot of the macro podcasts. I can't tell you the last macro podcast that I've listened to that has not been some worrywart economist talking about an upcoming recession. I mean, everybody's just so, we're just real tepid, tariffs. We're going to talk about tariffs in a little bit. But look, the market's being chased at this point. And,
but you do need that, mate. You need that. You need the bear pawn to. I think there's nothing wrong with evaluating what could go wrong. I mean, that's kind of part of our job as risk management, and understand the potential volatility. How much leverage is in the system, how short is the market in terms of vol in the short end. That could cause some big volatility. So it's good to understand the risk, but where you actually make the money is understanding when to choose and react to that. And obviously that's what prices come down to.
100%. Let's talk about when we react. Let's talk about tomorrow's jobs reports. And I want to talk about it just because something interesting really happened today during the ADP non-farm. So we lost, in private sector jobs, we lost like 33 or 30,000 jobs, whatever it was, well below consensus. And the initial knee-jerk reaction was S&P futures fell. Now we recovered and then some. By the end of the day, the momentum's great. But I think it's important that we take a step back and think about the way the market reacted to the jobs report, which I think it is important because we could see the very same situation tomorrow. Now, I was having a conversation with one of the Forex analytics analysts a little bit earlier today in our semi-private forum, talking about the jobs report, and his case is like, look, you've got the Trump administration. They're going to put out numbers. The numbers might even be horrible, but we're going to get revisions somewhere down the line. You can shave off 50, 60, 80,000 jobs of whatever number we get. That's probably like the real number, because when we get a revisions estimate like we do every year, it's going to probably show that there is 50, 60,000 jobs lost on average every month. But that's not what we're going to be trading tomorrow. Tomorrow, we're going to be trading the actual number. But my fear is if there is a slip in that number, if we're going to create 120,000 jobs, how about if the number comes in at, 30,000, 20,000, maybe even a negative number, slightly negative, will the market respond like it did today? And I think that's why tomorrow's jobs report is going to be really, really important. If it's not too bad, we don't meet the benchmark, and let's say unemployment stays at, 4.3%, I think the market's looking for. Let's say we create 70,000 jobs. It's a miss, but any type of dip, you saw the price action today, you probably have to be a buyer unless it's a really, really bad number. But what's your playbook with the NFP going into tomorrow, Chris?
Yeah, I mean, I think it's there's the distribution is it's a Goldilocks. What's the Goldilocks scenario? I think the market's got a pretty wide tolerance for for the jobs number. I think anywhere 110, 140,000 is kind of like the sweet spot. That's cooling, but it's still a good level of job creation. It misses a bad number, which has been given to us by ADP. But I think, the unemployment rate is really important here. So, I think 4.5 would be a huge outlier. That would cause the equity market down. But again, it comes down to where's my sweet spot. 4.3, maybe round it up to 4.4, be okay. Obviously, looking at average hourly earnings would be an interesting one. That's a sweet spot for equity. If we get that, market says, you know what, we move on. We've got a good level of jobs. It's not too hot, but the Fed is still in the market. They're still cutting in September. There's nothing changes that. Move on to CPI. The risk for equities is, like you say, below 80,000. That would be an outlier. And the unemployment rate pushes up 4.4, maybe 4.5. That would be a negative number. So you're right. I love the fact that you've observed the reaction function of how the market wants to think on a bad number through the ADP. And it has told us that we're fine with a slower number, slight miss, okay, but there's a number which we're not tolerated because jobs are so important that if it's bad, that bad will be bad for the equity market. It'll be bad for the US dollar, obviously. That's a really clean trade. And obviously you're going to see more rate cuts. For me, what's really interesting, Blake, is the July meeting for the Fed. Now, the bar to cut in the July meeting is very high. We've got about a 20% chance. But put the scenario, which may not happen, but it's a scenario of, let's say we get 80,000 payrolls, the unemployment rate 4.4, 4.5. That puts us on notice. The 20% goes up to 35%. CPI number on the 15th, if we get a core number, 0.1% month for month, the market's looking for 0.3. That July number becomes a 50-50 proposition, and that would make it very, very lively indeed. But, I still think that's a what if, and I still think September's the base case by far. But that conceptually could happen if we get a weak payrolls number. Certainly Trump in that situation, maybe he already knows. Maybe he knows that's going to happen. Maybe he's got the payrolls number, and that's why he's sitting there telling Powell he should resign. He probably has the number to hand. Maybe that's part of the reason. Maybe he's let the cat out of the bag. It's not the first time Trump's told us to do something and it's come to fruition, telling us to buy stocks and it happens, buy oil and all this stuff. He's got that. Anyway, let's go to the tariff risk because that's another factor. This is underappreciated by the market, right, Blake? Because if I look at the forward volatility markets, like the S&P forward volatility markets, they are pricing a bit of a move in payrolls, not too much. They're not really giving any credence to the tariff risk. The deadline's next Wednesday, and that's obviously for the rest of the world, reciprocal numbers, and then the 50% tariff which is going on the European Union. They're not really expecting too much from that. Of course, you've got the one big beautiful bill, which still needs to pass through the House, and the Senate's proposals, obviously lowering Medicaid and, actually increasing the full deficit spend to 3.3 trillion and increasing the debt ceiling as part of that to 5 trillion. We'll have to see if that can pass the House. I think that's going to be a tough proposition because there were so many Republicans in the House who are strong-armed into that last vote where they only got it through one. So, Trump's going to have to corral the troops. Mike Johnson's going to have to corral the troops to get that one through. Otherwise, it's going to get a bit more messy. But the tariff risk, we've seen the deal coming through, or it looks like it's going to come in through Vietnam. Are the markets mispricing the risk of tariffs here, that we go back up to pre-reciprocal tariffs, or is it the taco situation? We know the guardrails, and the markets just say, hang on, if we don't like it, we'll just de-risk and push up volatility, impact the funding markets, and you'll be forced to trade. So is there risk around this?
I think there is. Wouldn't you call it the inverse taco? I mean, right now, if you're well, it's kind of like an inverse head and shoulder pattern. It's like the inverse taco. I mean, Trump feels pretty emboldened right now with stocks at all-time highs. Inflation's down. I think we'll have to take a look at the jobs number tomorrow. That's going to be a risk event. But going into the 9th, you saw. It was last Friday. It was less than a week ago. Canada tried to throw on some digital tax, and he's like, "Deal's off. It's over. We'll give you our terms." And then they came back to the table like immediately. They dropped that idea and went right back to the table. I think him and Carney spoke over the weekend. So he's emboldened right now to take risks, and I think that, as you were saying, I think the market is underpricing that, and it's not something we're going to be dealing with today, but by next Wednesday, we will be. And speaking of which, I don't think we're going to be filming next Wednesday, will we?
We won't. We'll just take a few weeks off. Our producer's going on holiday. Nice of him. Michael Brown would always say that people who take holiday, it's a sign of weakness or non-commitment. But that's just my take. But taking a few weeks off, so we'll fill you guys in a bit more about that. But there we go. I'm actually quite interested about the picture choice here because I'm pretty glad that we don't have a picture of a taco actually, because I'm starting to look ahead to lunchtime. But
we got a picture of a chicken. I like it. Well, hey, that takes us over to the dollar, and the dollar has been absolutely just mauled. But Chris, I'm at that point, and I've been talking about it for the last 2 weeks. I'm now at that point that I am playing both sides of the dollar. I've been a staunch dollar bear all year. I think you and I have been just. It's been money. Let's face it. I still think there might be a little bit of gas left in the tank, but everybody's brothers, mothers, uncles, nephews, monkey's parrot, the monkey's parrot, is actually short the dollar, bearish the dollar. And that is the play du jour. I've obviously got my eye on the dollar. Make sure you guys are sticking around for all these technical setups that we're going to be talking about here in a second. But I do believe that this trade is a little long in the tooth. And that's the dilemma that I have going into the next couple of days. I think that we have a situation that traders are going to start, or traders or investors might start looking around and saying, well, what if? What if the jobs report is decent tomorrow?
Yeah.
What if, we're sitting here thinking about tariff risks, volatility. We don't want the dollar. We want the stability of the euro. But then you look at the Europe and go, but do I want that growth? Do I want U.S. exceptionalism? At what point does the dollar become more of a value play? And that's the dilemma that I'm at right now. So I'd love to get your take on the dollar for all the Pepperstone traders out there, because I know so many of them are dollar centric and play the dollar like I do.
Well, they're all long the dollar at the moment. I think, as always, let's just keep an open mind. I think, there's a possibility you get euro dollar stretching up to 120 in this run. I think so much good news will be priced in at those levels. Oh, sorry. Bag out of the cat. But I think so much, you've had this thing where it's gone from a structural issue where people were sort of talking about hedging ratios and, so $31 trillion of notional capital in US in equities and credit and treasuries from foreign investors, and people have lifted or changed hedging ratios because they wanted to. Became cheaper to hedge, and they had a more propensity because of erratic policy. And now it's become more of a cyclical play. You've actually seen much more correlation between yield spreads and relative growth rates and interest rate dynamics. But I think if you got up to 120, I think that would be a bit of a stretch. I think that would clearly where that elastic band was getting pulled up. I'm kind of hoping it actually gets there in a way. But look, I think, if we got a good payrolls number, and look, the trend in payrolls has been, if we're going to get anything, it's going to be an upside beat. If the inflation number comes out slightly hotter, but it's really the growth dynamics that I think you want to see. If you want to create a hotter US dollar, you need to see growth. It's not the inflation, that's a bad thing. But if some of the growth dynamics start to respond, if they can pass the one big beautiful bill and it's not seen as a term premium shock, and people say, hang on, this is going to be really good for growth in 2026, like Scott Bessent's saying, we could start saying to themselves, well, maybe the US is going to have a much better time in 2026. People start front-running that. The dollar shorts get closed. I don't know. Look, it's just a thematic that could happen. At the moment, we're all still dollar bears, but everyone's a dollar bear. You make a really good point. Every person out there, all the strategists are dollar bears. It makes no sense to lift a leg and go against consensus. And that, is quite an interesting place to be. So, just have an open mind that this could turn, and everyone will try and pick a reason for it. But at the moment I'm staying still bearish. But you got to be open minded to the possibilities of what's going on here. I think the Jay Powell situation is still a big US dollar negative. Picking a nominee by September, October, November, having them in place potentially for January, and the market will then explore how connected he is to Trump, how much of a puppet he is, or if that person will be to execute Trump's policy to get down to 1%. That person will have to distance himself to get the market's respect. But if they see any kind of politicized shadow Fed coming through, which of course they will do instinctively, that undermines Jay Powell. That's not a good situation as the market explores what that looks like.
100% agree with that.
Yeah. But there's obviously, we're trying to price risk around what is the second most important job in markets. I'd say Trump is the man at the moment, and Jay Powell is obviously the second. So it's a really important position for financial markets. That's just why we can't undersell it. Anyway, let's go to That's a Setup. Right, S&P 500, US 500. Let's have a look at it. Let's pictorialize it. There we go. So 62.31. Look at that side on the right, Blake. A lot of green on screen. I think it's up for X amount of days. It was 8 days. Yeah. The euro dollar was another one. I think we saw that up 9 or 10 days the other day, and closing out the worst run since 1973, as I say. So obviously watching that one. But yeah, we are seeing some momentum moves. It's a grind, and I like to see explosive range expansion like the next person, but this is a grind, and you can see that the market is holding that short-term moving average. Obviously, a nice impulsive rally. People are selling down. It's coming in, finding support. Makes a higher high. It's difficult to say from this trend. From the higher time frames, anyone trading a 4 or 1 daily charts, when you're looking at that, where's the probability in this? It just feels so strong. There's so much underlying momentum that the probability suggests for me now is whilst people look at valuations, people look at how far it's come from those lows, 29%, it just feels that this market is just getting sucked up. And so I can't be short this market right now. I've got to be in it. I've got to be long.
So the 127% extension of that entire chart, Chris, comes in at 65.30 or something like that.
There you
go. That would be a near-term target for anybody
65?
who's bullish, I think. Yeah, 65.30. Yeah.
Get in.
About another 200 points. Yeah. Yeah. So, hey, it seems like a hop, skip, and a jump away. But let's talk about somebody I know. I want to ask if you guys know him. You guys know this guy? His name's Justin Case.
Just in case.
Right? Are you familiar with Justin Case? Well, you should know him. Because I always like to know who Justin Case is. And just in case we get a good jobs report tomorrow, just in case, I look at currencies like the US dollar and Norwegian krona. You know, this has been, I don't know if you guys recall, about 2 weeks or 2 weeks, 2 months, 2-3 months ago, talked about if the dollar continues to, or the euro continues to go higher, the US dollar and Norwegian krona would eventually break down. It did. But now that we've had a prolonged move lower, this is what we call a reversal setup, and it's an inverted head and shoulder pattern. So I'm actually keeping an eye on the US dollar and Norwegian krona in case we break 1020. So just in case we have a good, strong number tomorrow, because everybody now is expecting a weak number. You know, thanks to the ADP today, everybody's looking at the data going, okay. Yeah, it's we're going to get.
I think the whisper number on Bloomberg's 95,000. So I think that's just indicative that people say, well, the median estimate is 106,000, but you'd imagine that probably in the dollar and they're positioned, below that number.
I can guarantee you, Chris, after Trump put that on True Social, like too late, should resign tomorrow, today, or whatever it is. Exactly what you said, Chris. Everybody's probably going, oh, shoot. I know I was. I jumped in our chat room. I'm like, I don't want to be long dollars going into tomorrow because of what he said.
So what are we thinking? 250,000 jobs? Unemployment rate of 4%?
Oh, my gosh. Could you imagine if we had a number like that? Just in case.
Jerome Powell just be sitting there going, aha, Schadenfreude. Fuck you.
Yes, right. Exactly. So anyway, that's the what if setup for tomorrow.
Yeah, good stuff. Yeah, I think that's a good one. A nice high beta dollar play there as well. So, I think you're on the money there. Bitcoin, let's have a cheeky look at that one. Look, we did see some outflows yesterday from the various ETFs, but I love the price action there. Look, we tried to make a new low in June. Yeah, the buyers stepped in, strong wick. It came straight back up to 110,000 level, 170,000. And we've just made a higher high. Very, very explosive price action. High range coming through. I like that one. Forget about the price. It doesn't matter too much, especially when you're trading on leverage. But I feel that this is a great place to be. Not just a short-term trade because it's going up. We've made a higher high. We've broken through that short-term consolidation zone. Take the time frame in, and it's made that pop there. But also, you know, if we're looking for a hedge against a potential fallout from this Trumpian Powell debacle, I think Bitcoin's the ultimate place to be. To be honest, crypto is the place to be because it does very loosely, and I'm the complete opposite of a de-dollarization, anti-reserve US dollar end of reserve situation. I think the US dollar is the reserve currency for many, many years. But I think the market, if we were to see a big fallout in the months to come, Bitcoin would be the place to be and the beneficiary of that hedge effectively.
All right. And you know what? If I had to do some imagination on your chart that really doesn't have anything drawn on it, that looks like a bull flag, and it actually looks like it's breaking out of the bull flag. So
you're always having a go at me about my chart. Sorry. Or like a mega. You could even look at a bit of a megaphone, couldn't you?
Could be. Yeah, actually, could be. If it did, I mean, you'd have Bitcoin at probably 125K. So anyway, looks good. Looks bullish. Can't deny that. All right. So one chart that I don't think looks as bullish as it has been is gold. I want to take a look at gold. I want to focus on it. I know a lot of your traders really focus on this chart as well. I'm really starting to think that, and I always look at gold and say, I don't have a bearish argument. I really don't at this point. Only bearish argument would be the dollar rips and we see the dollar squeeze, and because too many people are short, too many people are long gold, and we see gold implode. So that black trend line, that's the line that I think everybody should be looking at. It also coincides with the 618 retracement of the last move higher. That level is 32.50. So basically $3,250. That's it. If it breaks below 32.50, that's where things get a little dicey. I always try to think about, if I'm long gold, where am I not happy about being long gold? And that would be the level that I would say, I don't think I want to be long gold anymore. It's below golden fib level. It's below a trend line. Upside resistance comes in at 3,400 and 3,440, I think, are the two levels that I'm looking at. And I just think that gold's looking a little long in the tooth. It's looking a little frothy here. And again, this you could classify this as just in case's brother. If we get we get a good number tomorrow, dollar rips, gold might fall. And a lot of people own gold right now. So I think You have to just be on your toes. If you're long, don't get complacent. I love gold. I think gold's great. Will I love it more at 3,100 at the 200 DMA, or 3,100, either one of those two places? Yes. Do I love it here? I'm a little nervous about it, Chris. So.
Yeah, good call. Good call. Anyway, let's go to play of the day. Right, I'm going to start with a single stock one. Why do I like Apple? Well, I mean, it's had good run up recently from 196. But we're looking to earnings coming through. Look, we're talking about stock that has massively underperformed the market. Hardware has really taken a battering. In tech, it's really been semi-analog. We're talking about the AI plays have obviously done well. Software's done quite well, but the hardware space has actually been pretty badly beaten up. And Apple's down 15%. Down to year to date, significantly underperforming the S&P and the NASDAQ. So, is this time now for Apple to play a bit of catch up? Well, we're looking ahead at earnings coming from the end of the month, 31st of July, after market. And I think the market's sort of gone into this quite bearish about China sales and iPhone sales more broadly. I think we're looking at something like 46 million iPhone sales, and average selling price on the iPhone about 883. So I think there's definitely upside risk to the earnings. What we like about this as well from a seasonal perspective, there is not a stock that does better in July than Apple. They are up. They've closed the last 20 years with 18 months of gains in that period. So 18 times in July out of the last 20 years, they've closed higher. And that's because they typically have a strong reporting quarter in this quarter coming up. And there is seasonality. You want to see consistency. They're up 14 of the last 15 Julys in a row. So they just perform. And I think the market's warming to that seasonal factor. I think we get a breakthrough 214, which is the resistance level. I'm looking to add to that to get into the 200-day DMA. But don't like the story particularly long term. I think it's underperformed for a reason. But I think as we look ahead to this earnings, the market says, well, hang on, China could be a bit better. They've failed pretty badly on the AI front so far. Perhaps there could be some catalysts to say, that we talked about the idea about Siri using external capabilities there. And a stock that has underperformed, has catalysts and has huge seasonality. I still think there's some juice on the upside here.
Well, Chris, I just wanted to mention that as of about 35 minutes ago, my wife just added to Apple's earnings per share for the next quarter. So just
she just bought a new iPhone. Has she got the iPhone 17 Slim?
It's for my son. My son's phone just died. Like literally 35 minutes ago, she was sending me a text about buying a new iPhone, which is awesome.
Did he drop it in a pint or something?
I love it. I love it when but hey, Apple's a great utility company. I get it, Chris. What a great play. So, and I like to joke about that because I pay them like a utility company and I have for 10 years now. It's crazy. Right. Anyway, I want to talk about the euro. This is, you mentioned 120, Chris. It's a thing of beauty, buddy. Remember a couple of weeks ago, we were talking about coming to Papa Don trade. Yeah, the euro dipped right to that 114.20 level, gave us all great opportunity to buy it. That was 370 pips ago. But here we are approaching the 120 level. That is what we call a Gartley pattern. And I try to think about what would get us to 120 or near 120. It's something I've been talking about for the last week. Let's think about this jobs report. If the jobs report come in tomorrow and the numbers just underwhelms, and let's say it matches what the ADP showed us, as far as the ADP data, and we have an actual negative number, that could be the catalyst that drives us to 120. But I also will say, like we mentioned a little bit earlier, you got to watch price action because stocks didn't like that weak number on ADP, but it took a step back and said that's private data. It's not the BLS. The BLS comes in with a negative number and we see the euro rip to 119 to 120. You got to start looking for a reversal up there because I think the dollar could catch a bid if we saw some risk aversion. You haven't heard anybody say that in a long time, but if we see some risk aversion, if it somehow pops and rears its ugly head up at these levels because there's a negative, nasty jobs report, the dollar might actually catch a bid and catch everybody off guard.
You make a good point because if you look at one of the big factors here is that you do have one of the biggest inverse relationships between equities and the dollar that we've seen for a long time. And so the equity market's rallying for all sorts of flow-based reasons and the dollar's going down. It's another factor. So given that inverse relationship is as strong as we've seen or as unstrong as possible, you could, if the equity market was to de-risk because it's so high and people say, hang on, the labour market is really, really important to this equity story. Equity down, the dollar goes up because that inverse relationship has been so strong. Maybe it holds on the converse.
Yeah, and that's why I think we have to come tomorrow with an open mind. And remember, it's at the end of the week for us traders. So whatever flows you see following the non-farm payroll, if they start grinding, like let's say it's a dollar rally and the euro starts reversing, there's a good chance that's going to continue into the London markets on a Friday.
I think it's a big one. I think you'd have to see a really ugly number to get it. Otherwise, I think you say, look, the big macro focus at the moment is timing the next Fed cut. So you've got to see that a week immediately will just say, well, it's going to perpetuate and therefore the dollar to go down. So I think it would, I get your point, but I think it would have to be a really ugly number, a much higher unemployment rate, and to get the market to the dollar down on a de-risking situation in this. But it's not out of the possibilities. I think it'd have to be pretty ugly.
President Trump says that Powell should resign immedially.
He did, yeah, but and Polte as well,
Right.
A man running the housing National Housing Association telling Trump telling Powell he needs to cut rates.
Yeah,
there you go.
That's weird.
Yeah, right.
It's really sluggish out there. Let's just cut rates to help the housing market.
Please do. Yeah. Sack him. Anyway, let's call it a day. Thank you very much, everyone, for watching the show today. Thank you, Blake. I was working for the next section. Thanks, everyone, for watching. We're going to be taking a break for a couple of weeks now just to recoup the mind and have some holiday time and see loved ones and do bits and pieces. But Blake, we'll be chatting on the phone. And if anyone wants to reach out, just do so anytime on social media or in the channel and in the comments. And we'll be around to continue talking around. So good luck to everyone. Hope the trading goes well. And we'll see you in the flip side.